What's going on, everyone? Tom Martin here, your private wealth advisor here at Vaylark Financial Services. We have a lot to talk about today. I've been downloading, consuming, reviewing so much data points out there. So let's go ahead and just jump right on into this. So here's the agenda here. I'm going to start with economic policies, and then I'm going to go with fiscal policies, and then roll right into monetary policy. And then we're going to weave in some economics with the Fed policy out there because, like I said, the Fed is supposedly data-driven, and there's a lot of data out there that suggests that these Fed policymakers should not be unanimous with their vote to tighten policy further. Unanimity seems to be the order of day at the Fed, and I don't know if this is coming from Chairman Powell himself or what, but we do seem to have a Fed that says they're data dependent, yet the data that they're looking at seems to be lagging indicators. Now, I think the Fed is making some big mistakes here that could possibly throw us into deflation. There's data out there that shows that deflation's already within the system. So let's go ahead and start with fiscal policy. Now, we're looking at midterm elections right now, so basically there's nothing new happening with fiscal policy, which is just as well. In the midterms, we probably, as we usually do with midterms, is see a changeover or a loss of seats for the incumbent party in the House, and that will probably turn the House this time around. So I think that the policies looking forward are going to be focused on getting spending, taxes, and regulation down, while maybe opening up the spigots a little bit in terms of maybe some more energy production here within the United States instead of going to Venezuela or Saudi Arabia. When we talk about monetary policy, you often hear the term M2 or M2 growth. Now, I do not want you to feel left out of the party here, so let me briefly explain what that is. Now, M2 is a classification of money supply. It includes assets that are highly liquid, but maybe not exclusively cash like M1. M2 is mostly used as a classification for money supply here in the United States, over in the United Kingdom, and of course in the Eurozone. So M2 growth peaked at 27% in 2020, and it's been slowly declining ever since. It hit 4.1% in this past August, and we believe it might be closing at or maybe even below 3% on a year-over-year basis as of September, which does not leave a lot of room for growth or inflation, unless velocity is really picking up at a rate, and that's the rate at which money turns over. But I really don't believe that we're in an environment where velocity is picking it up. If anything, I think that individuals and businesses are becoming a little bit more and more concerned as to what's happening right there out here in the economy and the markets, and they're spending a little less freely. So if you take a look at M2, you also see that it peaked again in March, and this is very unusual to see sequential declines in money out there. We haven't gotten back to that March peak, and we might not ever get back to it the way the Fed policy is going right now. And I'd like to build a little bit of a case here that maybe the Fed is making a little bit of a mistake. Now, I say probably because I have to from a compliance standpoint, but I really do believe that the Fed is making a mistake here and reflecting a little bit more on that famous Jackson Hole speech.
There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job.
You know, we've come to recognize that Chairman Powell really does believe that he's the reincarnation of Chairman Volcker, and that we need him to take a big sledgehammer to the inflation that we have here today, much like Volcker did. And history has treated Chairman Volcker very kindly. He did turn the tide on inflation, but what he did, though, was he turned the tide on inflation that's been building for 15 years. It started in 1964 with the Vietnam War, and then with the Great Society. So many social programs at the time started under President Johnson, and for 15 years, fiscal and monetary policy just went to the Wild West and went rogue, just as we kind of look at that through history. And aftershocks to the system, like the oil embargo and the stimulus that came about because of it, both monetary and fiscal policy, we've never seen the kind of slowdown in monetary or fiscal policy that we're seeing here today. We have the Federal Reserve spending. It's down 14% on a year-over-year basis. You've never seen a decline in fiscal policy in the 70s. Monetary policies seemed to be on autopilot back then. The dollar was getting crushed towards the end of the 70s, adding to the inflationary fire that was existing there. So Chairman Volcker did everything he could to choke off the money supply and kill inflation, and it took a very long period of time to do that. And people really didn't believe that inflation had peaked, even though it did in 1981, until 1986 when oil prices crashed. So the inflation expectations were embedded within the financial system out there. And again, this was over a 15-year period. By the time that the Fed got around to tackling inflation this time, it wasn't a 15-year problem. It was a 15-month problem. And from my point of view, it was caused primarily by shocks, major shocks to the system that we've never seen before. We have never seen since the Spanish influenza, a global pandemic, and we didn't have supply chain issues and 2 years worth of them. All that because of COVID. And then, of course, we had another shock to top that off, and that is Russia's invasion of Ukraine. So these are some major shocks to the system. It wasn't a period of embedded inflation expectations out there, yet Chairman Powell has taken a huge sledgehammer that's actually much bigger, way bigger than it was then. It's probably 6 times as bigger now, and could be 8 to 10 times bigger if the Fed does raise the Fed fund rates another 75 basis points here on November 2nd. So what does this mean? Well, Chairman Volcker at the time was dealing with double-digit interest rates. He took interest rates from 10% to 20%. Now, by the time he did that, consumers and businesses had gotten used to maneuvering around inflation. So while that sounds a little bit of shock to go from 10 to 20%, and it did have some shock value to it, I won't deny that, it wasn't the same thing as what we're experiencing today with Chairman Powell and the Fed. Today, we've gone from 0.25% on the Fed funds rate to 3.25%, which is a 13-fold increase, not a 2-fold increase. So we have this situation where Chairman Powell is behaving as though what's going on today is way worse than what Volcker had inherited. Starting from a low base here, which interest rates were where interest rates were before COVID, right? It's really a big shock to the system, especially how long interest rates have been so low. I mean, it's been since 2008, 2009. Here we are in 2022. So if they raise Fed fund rates another 75 basis point, this is going to be a 16-fold increase compared to Volcker's 2-fold increase. Now, we've been expecting some serious ramifications of this. We are the Fed is extremely hawkish, they're extremely aggressive, and we've been expecting some ramifications due to this new monetary policy. And I believe we've gotten the first one here just a couple weeks ago, and it's starting to get publicized now, and people are taking notice on the news. Maybe you haven't, because honestly, you probably don't really care about it. So what I'm talking about is something called limited driven investing, or LDI. And it's where pension funds match their liabilities with the purchase of assets. And so in its pure form, pensions will match 1-for-1 the amount that they have to pay out to pensioners as they retire. Now, it would be great if they did match assets with liabilities completely from a safe investment point of view, but they don't. And with banks and the very low interest rates that we've had over several years, they've gotten used to investing a little bit more riskier. They're using derivatives and they're taking shortcuts to try to accomplish the same goal. And this is what I saw in the October 4th Wall Street Journal post about the UK pension crisis. And after a very long period of very low interest rates, we're now talking about this LDI crisis here in the UK. And the reason it's such a serious problem, I believe, is that the pension fund sponsors were beginning to think, and the banks were beginning to think, that interest rates would stay very low for a very long period of time, or at least for as far as they could see. And that assumption was built into the kind of derivative investing that they were doing. No one expected a sharp increase in interest rates. Well, once it did happen, pensions started getting margin calls, and they couldn't meet them. That's where they had to add money back into the system. And so the Bank of England had to step in here and basically pretty much do the same thing that the 2011 European Central Bank chairman did, Draghi. And basically what he said was, we're going to pull out all the stops no matter what. So while the Bank of England had been almost forced because of their currency depreciation out there, they are now following the United States Fed and hiring interest rates there. And this was what they found out was that this was going to cause a great deal of harm into their system. And so what they did was they reversed the policy. So we're supposed to be in a period of quantitative tightening right now, or QT, and yet this is another shift in policy, and it's an outright easing. And so what they said was they were going to continue until October 15th, which was just a few days ago. So now all these pension funds, in collaboration with the banks, are deleveraging, and they had until October 14th to do that. So they should be pretty much done now. So what do you do if you're deleveraging in an illiquid environment? All markets are experiencing duress today. So I think the Fed is a big part of that. So, I mean, what do? Well, you sell the most liquid asset in your portfolio. What are those? Those are going to be government bonds. So we're seeing the U.S. government bonds, which are held in pension funds all across the world, being sold, even though deflationary pressures are mounting all over the place. So we think this is a little bit of a financial crisis that's happening right now, and we think that we're going to see this elsewhere as the Fed continues to raise interest rates, as they so seemingly want to do. They're so determined. Certainly just a week or two ago, the Fed was full of speeches from all the Fed members reminding everyone that they're going to take interest rates up until they get to that 2% inflation. Now, we're also seeing other changes here. We've seen China intervene to limit the weakening of the yuan. That was on the news this morning. We've seen Japan doing the same thing. That was also on the news this morning. So what's going on there? Well, when Japan is trying to support its currency at 145 yen to the dollar, what it's doing is it's selling dollars, US dollars, and buying back yen. Now, that's good in a way. And it's kind of what the Fed should be doing on some sort of level there. What it's doing is it's providing dollar liquidity to the rest of the world. And China's doing the same. And so we'll see what happens from here, but I think this is going to get pretty serious, and we are kind of reaching that cathartic moment here. And I do think it all started with this UK pension crisis, and the Fed has acknowledged that there are internal ramifications of what it's doing, but first and foremost, what it's thinking about is the United States. And this kind of reminds me of two accords that came out in the 80s, the Louvre Accord and the Plaza Accord. And this is where Treasury ministers all around the world agreed to sell dollars to limit deflationary impact on the rest of the world. Now, when I say deflationary impact, there are countries out there that their currencies look like they're falling apart. So they look like they're falling into hyperinflation, or that they're already in hyperinflation. But really what's going on here is they're being strangled by dollar-denominated debt. So that's US dollars. They have US dollar debt out there, and they can't service it. So this ends up being quite a deflationary situation over the long term. And so what we're wondering is, what are some of the weak points or weak links here in the United States? Is it our pensions? We do know that there are LDI strategies here in the United States. They're not as leveraged as we understand, but again, no one really kind of knows for sure. So if that's not likely a problem, then what are some of the weak links that we're seeing out there? Well, I've been worried about auto credit for quite some time now, and I think we have a little bit more reason to. The Manheim used car index was released a few weeks ago. Effectively, it's a value index pricing, and it dropped another 3%. It was already at a 4+% decline as of last month in September. So what we have now is on a year-over-year basis, it's gone from 54% as of April 2021 to negative 0.1% as of last month. So there you go, Fed. There's some indication right there that deflation is in the system. Now, that index peaked in January. It's now down 14% since January, so it's declining at more than a 20% rate. So why is this important? Well, a lot of auto paper out there, and when I say auto paper, I mean debt, make the assumptions, or at least the investors make assumptions about the residual value of cars. And those residual values have been going up. Maybe not as much as maybe the used car index, but they have been pretty firm. So if we're right, the used car price index here is going to collapse very soon. Why? Well, many people bought cars during COVID because they wanted to avoid mass transit. We had stimulus money. We had some extra money out there. I even saw some relatively unwealthy families, as I'm kind of driving down within my own town, buy like Mercedes cars. So it's been pretty crazy and surprising. Nonetheless, though, a lot of people were very happy to see that the used car prices were going up. Even and I feel that at some level they felt that the coast was going to be clear. They would sell that new car back into the market, right into the used car market. And as I mentioned before, used car prices were up 54% on a year-over-year basis at one point. So and now they're flat or down. And now dealers who were scrounging for used cars, they're paying too much money for these used cars now, and they're sitting on losses out there. And what they're going to have to do is disgorge those inventories, because those inventories cost money to carry, especially as interest rates are going up. So what they're going to have to do is they're going to be forced to sell these used cars. And we feel that's already happening out here right now. So, I mean, if you're in the market for a used car, go look for it. So there is about $1 trillion of auto paper out there. Now, this is not going to be a big systemic risk, but because auto paper was one of the best performing debts out there in 2008 and 2009, this is we're going to see a lot of investors going back to that 2008, 2009 success, buy these auto debt loans, and they're going to get a big surprise. So auto cars is definitely, car notes are definitely a big risk out there. What's also another risk out there? Well, corporation debt. Corporations have a lot of debt. And I've been working my book of investments to trim these corporations off of ETFs and mutual funds that we have, because it is a big risk. Now, why? Well, they've been catering to short-term shareholders who wanted them to buy back shares. They didn't mind leveraging up to do so because debt was so cheap at the time, or maybe they wanted the company to pay dividends, and they didn't mind that they were leveraging up because debt has been so cheap for such a long period of time. And this is going to be a big problem for certain sectors of the economy that are especially in throes of disruption, both secular and secular. So I think that retail sector is going to be one of those. I remain astonished at how much inventory is being built up out there, and the way that we're looking at this from a deflationary point of view, it's going to be a bigger risk out there now. And this pipeline is full of deflationary indicators out there, starting from commodities, which we'll get into here in a moment, but at the end of the pipeline, downstream to the consumer level, retailers are awash in inventories. And the latest one out there is Nike. Nike is both a retailer, but it mostly sells to retails. First of all, Nike global sales up 3% in this last quarter. Its inventories increased 44%, and that's as of the August quarter, so that's pretty recent here. They were already signs that the consumer was weakening at that point. North American inventories, Nike's North American inventories were up 68%. Inventories in transit, mostly from Asia, were up. So these are inventories that are on ships. They were up 85%. So you know what's going to happen here. In order for them to clear shelves, Nike is going to have to cut prices. Retailers will as well. And I believe this is just a small microcosm of a much broader problem out there. And we think that we're going to see this in full force this holiday season. So this holiday season, you should be demanding bargain pricing deals out there because these retailers need to trim off this inventory that they have. Now, November 2nd. The Fed is going to increase rates. They're pretty unanimous here. What they said is we're going to raise rates another 75 basis points. And we took a look at the data for last month because the Fed seems to think that they're data dependent. So if they are data dependent, let's look at the data. So we're going to take a look at the economic indicators out there. So we looked at all the data for of all the indicators for September last month and only last month. We found 22 firm or strong indicators suggesting employment and inflation might linger at higher than expected rates. We found 22 weak indicators, now pulling out the ones that are specific to employment and inflation, since those are the two variables that the Fed is weighing in more than any other. And we find that on the firm side, what the Fed didn't really care for was the core CPI or consumer price index and the PCE or the personal consumption expenditures at 0.6% month to month, even though the headline indicators were flat to down. PPI core 0.4, non-farm payroll, which came out just a couple weeks ago, pretty much in line, 263,000, but there was a drop in unemployment rate from 3.7% to 3.5%. Now, the reason for the drop was a labor force thing, not employment. So labor force is shrinking. The labor force participation ticked down a bit. So I really don't take that as a reason, or at least I don't take it seriously, because I do believe that the labor force participation will continue to trend upward, especially if we're in a weak or as an economy as we believe we are. And then on the weaker side, again, if the Fed were data-driven, they would be paying attention to the employment ISM index for September, which was below 50%, which means it's contracting. Job openings or JOLTS, they dropped 1 million in just 1 month. So we're still strong at 10 million, but it did drop 1.1 million. That's a very big drop for just 1 month. So job openings are declining. We also see the surveys out there, and I think that in the U.S., there's 300 major employers out there that have announced layoffs, and that's reflected in something that's called the Challenger Layoff Survey. And those layoffs, which are a broad-based company layoff, they're up 68% on a year-over-year basis. So I would imagine that would also the Fed would also be considering these leading indicators out there, which in every recession or recovery, at least in my experience, that the Fed has paid a lot of mind to. It dropped 0.3% last month, so that's September, and that makes for 5 consecutive months of decline. So the general rule of thumb here is that once you've got 3, you're in a recession. So the Fed might be saying that it's data dependent, but it's looking at the data that it wants to, not necessarily looking at the totality of the data that's out here. And it's making assumptions, I think, and we think that they're mistaken there. This is very much a Phillips curve Fed. Now, you don't know what that is, but a Phillips curve is the economic theory that inflation and unemployment have an inverse stable but inverse relationship. So the Fed is basically saying here that the rising output in employment causes inflation, or at the very least that they're highly correlated, and that's not really true. So what the Fed is going to do here is force layoffs, really, and that's what it's going to consider to be successful, and that inflation's coming down. So, but if you take a look at the data from the 80s, 90s, and 2000s, you're going to see that inflation came down during times where the economy was strong. Why? It's because of productivity. Productivity growth is a critical byproduct and an anti-inflationary byproduct of good, strong recovery. So we'll see what happens. Okay, so I'm going to refer to some numbers here, some numbers that some economists and colleagues have prepared. So we're going to go into commodity prices here. Again, we have a data-driven Fed here, so let's take a look at the data. So we're going to start from their peaks and then work into a year-over-year basis. But from their peaks, we have gold prices down 17%, copper down 30%, lumber down 73%. And just think about that for a moment. The housing is collapsing. Iron ore is down 45%. Infrastructure around the world has run into trouble, especially China. Corn down 17% from its peak. Silver down 29%. DRAM prices, which are chips and semiconductors, they're down 46%. The Baltic Freight Index down 48%, which is an indicator of supply chain issues. Then we have the Baltic Dry Freight or Freight Dry Index, which is just for dry goods, down 65%. Oil's down 29%. So again, that's from their peak to where we are now. So just taking the evidence and putting together like this, there's a lot of data out there to be driving the Fed, which is what they say is happening, but we don't think that's happening. I just rattled off a lot of examples there. All right, so moving on to market signals. So we're going to go into markets and then we'll wrap up pretty quickly after that. Not much to say here. Markets are selling off all across the board. That's very unusual. It's usually associated with crises. Yes, we do have a little bit of rallies here and there, this week especially. And more convincing evidence to us that the Fed is probably a little too tight right now, and that it will pivot. And when it does, it'll probably do so pretty significantly. So now first, it might come off as a little bit of rhetoric. So keep in mind that the Fed always likes to tee us up for what their next moves are going to be. So when the Fed does pivot, it's going to come off in their language first. So that's their rhetoric out there. And we haven't heard that yet, despite all the evidence that I just shared with you. But that evidence that I just shared with you tells us that the Fed is going to get the message loud and clearly, somehow, some way. It might not be showing up through the numbers that they're looking at, but it will. There are huge lagging indicators out there. The Fed is basing their policy on lagging indicators, which is not what they're supposed to be doing. In the U.S. alone, if you take equities and bonds and you take a look at what's happened since the peak, you're going to see that the loss to investors has been more than twice of what we saw in 2008 and 2009. That's how bad it is, because bonds are selling off with stocks this time. And one of the reasons for that is the seizing up of liquidity. As I mentioned, if people are facing margin calls, if they're in financial difficulties, they're going to sell their most liquid assets. They have no choice, especially if there's margin calls involved. The most liquid assets that people have, that companies have, they're going to be government bonds. And I think that's why we're seeing a backup in the government bonds here, despite all of the deflationary signals in the pipeline. Now, interesting enough, one price indicators associated with innovation is holding up pretty well right now, or at least it's beginning to hold up pretty well, and that is Bitcoin. It's interesting to see that it flatlined in the past month while other indicators are reaching for new lows. Now, this isn't really surprising, especially if we are, in fact, in a late stage bear market, because in our experience, this is where innovation starts to outperform in late stage bear markets. Why? Well, this is where innovation tends to happen. Innovation is the new leadership. Innovation solves problems. Innovation solves the problems like we're having today. Supply chain issues, food and energy shortages. Think of the genomic research out there, electric vehicles and so forth. Researchers used state-of-the-art genomic sequencers to quickly sequence the SARS-CoV virus vaccination. And so we do believe that innovation should outperform if we are in fact at the end of this bear market, and if the Fed is close to pivoting, even if it's just in their language and their rhetoric. With that, I'd like to reassure you that it does feel like we're moving in the right direction. We need to go through this, and I think that another 75 basis point increase, if that's what the Fed is going to be doing, is going to result in some sort of financial signals there that the Fed is going to have to pay attention to. We do believe that the pivot is close. If nothing else, it's going to be in their rhetoric in the short term, and we certainly hope that the Fed gets away from this need for unanimity and a united front when in reality we should be having all these Fed members and these presidents for a reason to debate. And we feel that debate right now is being stifled. That debate should be driven by data, but I cannot see how they're debating the situation right now. If they were debating, they would not be unanimous in their decision right now. They are hiking rates very aggressively because they've been behind on the bit, and I'm just a little worried out there. So let's hope that there's some dissenters among the Fed. Let's hope that there's some change in rhetoric there. There are all kinds of reasons, data-driven reasons out there, and so we hope that the Fed is paying more attention to all the data here instead of just a few pieces of lagging indicators. So toward the end of 2019, I was preparing for a recession. Equities were overvalued, bonds were performing a little irregular in my opinion, and then COVID came. That brought about stimulus, and then we avoided that recession. We didn't get the crash. So I still believe that original recession that I was expecting for is still baked into the system. Right now, many are saying that we're not in a recession due to the jobs reports or jolts out there, but job numbers are a lagging indicator, and we have to keep in mind that many employers have been starving for employees. Many service companies still are. While there are layoffs occurring, I don't believe that employers are going to go out of their way and start firing employees. I don't think they're going to let them go without a fight. They might be willing to suffer just to keep them, knowing that it's going to cost them more in the long term to bring them back. So in order for the Fed to taper out inflation, though, we are going to have to see people go. That's just the way what the Fed believes right now. If we have job losses, inflation will taper down. So it's just simple economics to them. There are reports out there that will cut about 179,000 jobs per month starting next year. And when that happens, you will know that the real recession has started. So I believe that the markets are fairly priced right now. It will take time for all these rate hikes to kind of reflect the system. I do hope that the Fed kind of pauses, wait for this rate hike and inflation to kind of take hold and then go from there. Right now, the way that I see this is that additional rate hikes out here is going to take us too far. That could depress stock prices down further, push the U.S. into deflation. So for those of you that are thinking about retiring in 2023, I recommend you building up your cash reserves right now. Pay off your mortgage, pay off your consumer debts out there. Don't carry that into the retirement. Interest rates are going to be high for quite a bit. So I'd like you to avoid that if possible. Of course, make sure you schedule a retirement session with us. If you're not working with me, by all means, reach out to me. I'll give you a complimentary retirement second opinion out there. And if you do get let go next year, claim unemployment and then maybe start to retire. So make sure that you subscribe. Make sure you hit that bell notification here on YouTube to let the algorithm know to share this video with others. And I also don't want you to miss my future wealth tips out there. My team and I want to be the last advisory team that you'll ever need. So with that being said, I wish you a very happy weekend or whatever day of the week that you're viewing this, and we'll see you soon. Take care.